Let's get right to the floor show. Joining us now, billionaire founder of Fisher Investments, Ken Fisher. Ken, forget week to date. This quarter, all the majors are up double-digit percentages. Really impressive here. And you look at the Nasdaq up 23% just this quarter, S&P up 14.8%. Dow Jones Industrials up 11.25%. And according to Bank of America, we thought this was interesting and wanted to hear your thought on that. In the week ending June 17th, mid-cap funds drew a record $19.9 billion in weekly inflow. Small-cap funds had their second largest weekly inflow on record at $12.3 billion. And weekly inflows for tech shares, I believe, $19.2 billion. What do you make of the market's overall resilience here? What's driving it?
So first, it's a bull market. It's not only a bull market as you've depicted it, which is correct, but it's also a bull market globally. If you think about it, which most people in America don't because we don't have to, the global markets are up about as much as the U.S. market, albeit they don't have the tech that we have, which is up more than the rest of the U.S. market, which tells you that their market, non-techie, is actually doing better than our non-techie market. But the fact is, it's just a bull market. It's a bull market almost everywhere. If you look at places like Spain and Italy and Austria and they've all been hitting new highs. Not all of them, that's not true. Lots of new highs all around the world. It's a broader market than people think it is.
I'm hearing your thesis kind of develop that you're beginning to like overseas markets.
So first, a lot of parts of tech are frothy. I'm not saying euphoria. Euphoria is different, and we're not yet in a euphoric market. That's actually easy to tell. But there's lots of parts of the tech world that are frothy, and therefore that says you want to be in places that people haven't gotten excited about yet as this bull market progresses.
Okay. In November, though, you had said AI had not yet had any stock market bubble or started that. That was November. Do you still feel that way? Does that still stand?
This is not a bubble. This is different than a bubble. When you get to a bubble, you get a demonstrable phenomena that we've seen none of yet. With a bubble, you get lots of new issuance of IPOs, which secretly means it's probably overpriced. But in this case, not of substantial companies like these AI companies going public, AI-oriented companies going public that are big, substantial, done a lot of stuff, but instead, little hopeful, nothing but a hope and a prayer and nothing there, but they're raising money. We've seen that so many times in history where people are taking advantage of the opportunity to suck in money to create something at a company as opposed to they got something that may be overpriced.
To the IPO point, though, SpaceX launched on Friday, its IPO a week ago today. It's done incredibly well, although the past couple of days it kind of retraced and got a little bit closer back down to earth. Not by much, though. I mean, they've raised $75 billion. They have a market cap now of more than $2.5 trillion. But you coined a phrase. You said IPO means it's probably overpriced. Are you saying and advising people, do not go into the IPOs of OpenAI and Anthropic when they first launch? It's too dangerous?
I'm not talking about any specific one. I'm talking about the category. The fact of the matter is, if you look at IPOs going back to 1990, and I'll be covering this in some detail in my New York Post column that comes out later this weekend, the fact is a little under half of them are up in their first month. Go out 3 months, and the fact is they're down and down by about 5%. 6 months, 11%. A year, 25%. 2 years, 30%. And of the almost a half that were up in their first month, 70% of them are down after a year. If you go back in history, you look at famous names like Facebook, could have bought it cheaper later. If you look at famous names like Uber, so many of these could have bought them cheaper later after they were public. This is probably overpriced.
What's your favorite area of the market right now?
So let me take you back to what you were talking about before, Liz, because you were doing it very well. Actually, you always do. But the fact of the matter is, when oil is strong and people are afraid of oil pricing, we got a problem because you can only cut back a little. Gasoline, heating oil, whatever it is. When that happens, it pinches budgets. And what comes out to be hurt? Luxury items. luxury items do badly, and you can see that in the leading luxury names this year as oil's done well. Now, as oil's going to be irregularly going the other way and has been, luxury does better because the budgets get unconstrained. With luxury items, you don't have to have them, so the high price oil forces them down. When the price of oil comes down, they rejuvenate.
Luxury names, we're looking at LVMH, Hermes, Kering, which is the parent company of Gucci. You've got a lot of these names that have struggled, and in essence, you're saying they have an opportunity here to get cheap.
You want to buy them cheap? They became cheap. They became cheap because of high oil.
High oil. We're watching it come down, though, slowly but surely. Actually, not that slowly. Just a couple of weeks ago, it was at $119 a barrel. Ken, wonderful to see you on this Friday. Good to see you. Thank you so much.
Always great to be with you. Thank you.